run up into buy stops, we hit it, and then we price lower. So isn't this low taken out right there? Isn't that the 2022 model? We have buy stops taken here. And then we have a shift in market structure. Does it have a fair value gap? Yep. Order block, extend that forward. Trades up into it, breaks lower. Notice it doesn't completely close in the top of that fair value gap. Why? The order block stops it. There's a change in the state of delivery there. Then we have price break aggressively lower again, moving below this low. We have another inefficiency. Buy stops were taken here. Here's another model 2022. Fair value gap, trades up into it. The low of that candle. Now watch, listen, this is for the order block freaks. Okay. These two up close candles are consecutive. That's a bearish order block. The low of that candle, extend that through. What is it in overlapping? Consequent encroachment of that gap, midpoint. It's real close proximity to that. So if we have a coupling or a confluence of these PD arrays, half of this gap, consequent encroachment. I already know some of you are freaking out that are brand new, like, man, this is too complicated. Keep showing up. You'll learn. I promise. It just takes time being exposed to it over and over and over again. You'll see it and you'll pick it up. But that low of those two consecutive up close candles, that is your order block. That's your change in the state of delivery. Why is that the change in the state of delivery? Because it's also in close proximity to the halfway point or consequent encroachment of this inefficiency or sell side imbalance, buy side inefficiency. There's only one pass through between this candle's low, this candle's high, that one candle there. Half of that is about right there, which is right at just about that low of that candle. Price stops dead in its tracks right at that order block where the change in state of delivery. It occurs. Then it prices lower and takes the sell side out here. Let's go into a deeper dive with this right there. Just know that these two consecutive up close candles, that's my bearish order block. The change in the state of delivery is at that low. We're going to look at this candle right here closer on a lower time frame. Here's that same price delivery that was on the 15-minute chart, now on a 5-minute chart. It's anchored to what would otherwise be a random candle because you don't know what I'm showing. If I just showed you this chart here, some of you nod your head, yeah, I can see that. But without the context that I just gave you on the 15-minute chart, you're lost because you're going to look at this up close candle and everybody else with Tom, Dick, and Harry's mentorship, they're going to say, this is the bearish order block. And I'm going to try to sell short up here. And it never went to that order block. ICT is a fraud. It's fake. It doesn't work. Yada, yada, yada. And that's why you get these people out there saying that kind of stuff because they don't know how to do it themselves. 15-minute order block. It's parent. It's parent. This is subordinate. This is a 5-minute chart. It's going to be subordinate to the 15-minute candlestick chart. So the narrative is derived on the 15-minute. Then you look for signatures on the 5-minute to align with that. So this is that low of those two up close candles on the 15-minute chart. I'm extending it forward. Can you see visually how that's essentially half of this range right there? That's why it goes right up there and stops, not because Gann said so, not because there was a wave that Elliott rode in on. It's not supply and demand. It's not harmonic. It's nothing else but the algorithm. Okay, the price goes right to that price level and stops dead in its tracks. Like some invisible force field said, no, you shall not pass. That's why this level here stays open. Doesn't need to go up there. Why? Because the order block is the change in the state of delivery. It stops right there. So that means all this price run up above these buy stops here. It goes above to engage those buy stops, yes. But does it go up to some random level? How do you know how far it's going to go when it's running stops? This. I'm doing this. This is technical science. I'm reading everything in the price action. This movement lower from this high down to that low, that's your price swing. That's your dealing range. And then you have to split that up. Equilibrium. So we went into what? A short-term premium. To some random level? No. A 15-minute bearish order block. That is the consequent encroachment of this fair value gap. So if it does that, runs up here and takes out the buy side, why would smart money want that? Because they're going to sell short here. Where are they going to what are they going to do with that? They're going to offset distribute their shorts by accumulating the sell stops below that low. And that's what you have right there. So smart money sells short. All through here, they're selling short. Selling, 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 up to that point, and they stop. They can't assume anymore, because this is where they're being told this is it, that's the threshold. Then, as price goes down, they're starting to distribute. They're selling short, but they're buying back as price breaks down close candles. Right there, rallies back up, and then right below that candle here, once it goes through that, they're covering more, and then covering right below the low where the sell side is. That's real institutional order flow. That's real order flow, Jack. Okay, whether you like it or not, whether you like me or not, that's the facts. If we look at how highs, okay, this area in here, if we look at how highs have buy stops and lows have sell stops, like down here, I want you to think about that premise like this. This is, whenever I'm looking at price action, the first thing I'm looking for, the first thing is any inefficiency. I want to see, is there any imbalances like this one here and this, well, not so much on this one, but the 50-minute chart did have one. But any inefficiency like that one right there, see that? So when we look above old highs, we don't need to see a depth of market or a ladder or volume profile or anything like that to know there's stops above that. It's just common knowledge. There's going to be short sellers. If the market traded lower, there's going to be somebody that's short. And if they're short, chances are they're trying to protect or, hold some measure of unrealized profit if they're wrong. And below old lows, if the market has rallied, our assumption is that there's going to be sell stops below that. Somebody is going to look at that as a long position, and they're going to place stops below that. How do you protect a long position? It's protected with a sell stop below some important low, they call it. Okay, so that's easy retail 101 logic. So what I try to do is I look at how I can take that and turn it upside down. How can I attack retail theory? How am I going to go in and go after Goober? Okay, Goober's in here trying to trade off of something he learned in a book, and he thinks he's figured out the whole idea of how markets move around, and he has depth of market, level 2 data, things are on the right side of his chart passing through. He feels like he's technically inclined now, and he's still doing what? Putting stops below old lows and above old highs. So that doesn't change anything, okay? So I cut all the nonsense out of it and go right to the brass tacks of where's liquidity and where's inefficiencies, because that's exactly what the algorithm does. And it does it on a time delivery. Everything's by time. So when we drop down into the 1-minute chart, buy side liquidity, this high right here. Why this high? Why am I going to refer to this high here? Because when price made this low, it started from that high right in here. Now, I'm not talking about this high. I'm talking about this delivery, that little run right there. It stemmed right from that high. I want to see that high broken. If it does so here, then we have a shift in market structure. Well, why can't I use this one? You can if you want to be ultra aggressive, but it could fail on you. You could use this one, but it could fail on you. I want this one because this one is the parent price swing that sent it down here to take out the sell side right there. So I want to see that high broken on the upside. Trades into a fair value gap there after the shift in market structure. That, my friends, is what? Sell side taken, shift in market structure. There's your model 2022. It doesn't work. It's nonsense. Wrong. You can't read a chart. Fair value gap rallies up. Do a price swing measurement from this low up to the high with a fit using the bodies, not the wicks, because the bodies tell the story, the wicks do the damage. You will get that high. So model 2022, buy the fair value gap, first profit, buy side, and then see if you can get a runner into that inefficiency, which just happens to have that midpoint consequent encroachment and the 2-candle order block, the low. That's what that is right there. And you see how beautiful it is? It stops right there. It's almost like it's meant to be perfect.